Okay, so this is the second trial that I'm doing of going this how to invest for beginners, and really it's episode 2, and I'm going to talk about when to sell a position. So people will be coming in and hopefully they'll be dropping me a couple of questions, and this is something that I'm going to be running every Friday at 9 a.m. Eastern Time, and the idea is really that you come on board and you ask questions that you want to know about investing, and it's really something for us to kind of discuss and put it out there. And you don't always have to agree with me, but you can leverage my experience and say, okay, Michael does it this way and I agree with him on this instance, but I don't agree with him on that instance, and just to really start thinking about investing. So specifically today I want to talk about the topic that very much excites me, is about when to sell a position. So just to invert that slightly, I'm going to just mention something. So the most important thing is, when it comes to investing, is to align yourself with a good business. So you need a business that is strong. You need a business that, in the best case scenario, has management that has significant skin in the game, and you want management that has at least, let's say, 2 or 3 percent of the stock, hopefully more. If they're a smaller company, they can have more, but you really want to be in a position that you're buying into great companies. This doesn't necessarily need to be a company that's growing very strongly. You can have a business that's growing less fast, but is more free cash flow generative upfront, so that's kind of compelling. Or you can be in a business that's growing quite quickly, and by quite quickly I mean that it's growing at north of 50%. And what you want, you need to understand the type of business that you're getting involved in, because it's a different type of mindset, okay? If you kind of be investing, let's say people kind of generally like to be investing in high growth names. If you want to be investing in a high growth name, you want to be investing in a leader of that space. You don't want to be buying the tier 2 or tier 3 company. You want to be in the best company, hopefully with management that has a lot of skin in the game. And you also want to kind of think about is just leveraging into your position slowly. So you don't want to kind of find something that's really kind of cool and compelling and just put all your, let's say, 10% of your capital in that position straight away, because you don't know the business enough until you've been a shareholder of that business for a while. Until you've been the owner of that business for a while, you're not going to really know. So I'm just going to walk you through very quickly about what type of business to buy. I'm just going to spend another minute or so, but really the focus of today that I want to talk about is how to sell the stock. That's really something that, and I can see there's a few people already on the call, so if you want to kind of be asking me your questions, I'll just kind of, when I get a moment, I'll get around to it. So ideally, you want to be buying slowly into the position. You want to be buying into great companies. You want to be buying into companies that are the leaders in the space, growing their revenues and expanding their margins. You don't want to be buying into a company that is kind of like growing its revenues, but the margins are compressing and it's becoming less profitable. That's not very, very exciting. You want to be buying into a business that the person that looks at that business in 3 years is going to be thinking, wow, this is a really great business. That's what you want to be buying. You want to buy a business for today that over the next year, year and a half, 2 years, as the person that buys from that point, from 2 years out, looking out for the next 2-3 years, that they'll be thinking, wow, this is a really kind of great business. So you want to be, that's how you should think about buying into the business. But my focus of today is really about how to exit the position. So let's say that you've done a great investment, okay? The investment has done really well, and in the last 6 months the stock is up 100%. Wow, you tap yourself on the back and you've done great. What do I do now? What do I do? I'm kind of holding on to these gains. My advice is, just because the stock has rallied a lot in a shorter period of time, you're not obligated to react. That's the first thing. A lot of people feel that they have to do something. The stock's going up, they have to do something. And I'm going to tell you that you don't have to do anything, okay? So let's say you put down 10% of your capital, it's up in 6 months and you doubled, and it's now 20% of your overall capital, assuming everything else is flat, okay? And you don't have to react, you don't have to do anything. What I would say is, as much as possible, the real return that you make as an investor is in letting that gain continue to go forward. And yes, it does happen sometimes that you can round trip the investment. So you buy, it goes up, and then it kind of falls back down. Has happened to me quite a few times. And let me tell you from a personal experience, it actually isn't that bad. Once you get into the mindset that this is just, how you do as an investor, you're going to have gains, you're going to have losses. The example that I always put out there is if you're a chef and you're making the world's best lasagna, you're going to sometimes have to throw out some of that beef in the bin. That's just the business, right? So you're going to have some loss, you're going to have some positions that don't work out. And if it does round trip, it's a rare instance. And having that happen to me, I don't look back and say, I wish I could have done something different. I can give you some examples. So for example, Fubu is a company that I own, and I bought it at a cheap price, and I saw it go up to $60, and I've done really well there. And I held on to it, and I saw it fall from $60 to about 45 to 30 to 25 to 20 to 15, and that was a business that nothing really in my mind changed about it. They were doing everything right, but it round tripped. And I can tell you that looking back at it, I don't say, I wish I'd sold out, because there's nothing wrong with the business. Yeah, people kind of lost the enthusiasm for it, for example, but that doesn't make any sense to me that now because the share price has gone in a certain direction that I'm obligated to sell out. That's the first thing that I wanted to kind of put out there. And the second thing is that if you're lucky enough in this business, if you buy into 5 stocks, if you're lucky, you're going to have about 1 of them work out. If you have a really successful period, you're going to have 2 of them work out in a period of a year. Let that winning position run a bit more. Let that capital that you've accumulated, that profit, run. And even if it kind of comes back down at some point in the future, you will most likely recoup your original investment. Remember Buffett's rule number 1. It's just about not losing capital. Every time that you deploy capital into a position, you want to salvage that capital after, let's say, you've been invested in it for about a year and a half. That's really the game. The game is you deploy the capital and you try as much as possible to recoup the capital while being humble and being honest and saying, yes, okay, I'm going to have some losses as I do, but the process is this. Rule number 1, don't lose the original capital. So if you have a position that's working out favorably for you, just try to ride it out a little bit more. And even if you say, okay, I've held that position now for a year, that's a different story, okay? So if the stock goes up in a 6-month period, and everyone else is rushing to take the cash off the table, and there's going to be a lot of people looking to take that excess, the profits that they make off the table and quote unquote de-risk their position. But what I will say is that really try to keep your nerve, try and keep really cool, try and keep really patient, because everyone else is going to be really shouting, and I can guarantee to you the voices are going to be so loud, and you just have to kind of say, okay, I've done my analysis, I am aligned in a strong business, and I'm going to just continue. After you've held it for a year, there's a change in perception, okay? So after that period, let's say a year and a half or 2 years, for example, just for the case of the discussion, there's a change in perception. The investors are seeing the new company that you saw in the past. So in most instances, you made the investment and it blew through your expectations, okay? That's why the share price is higher. Ultimately, let's just be honest, you didn't know how things were going to unfold. You had this idea in your mind and you hoped for the best, and it worked out and it blew through your expectations, and that's why you're holding on to substantial gains. Now, after a year, that's the new story out there. Sorry, let me just say this question. Yeah, so it very much depends on the type of investor that you are. So the way that I look to invest in things that are slightly misunderstood today with the idea that they'll be better understood over the next year. So I'm looking for a re-rating. I'm looking for people's change in perception. The example that I always highlight, because it's a famous stock that everyone knows, is Fubu, because there's, you don't have to agree with me on Fubu, but there's this perception right now that, okay, the business sucks, the margin sucks, it's never going to be profitable, there's too much competition, and there's a million reasons why people believe so. But if you actually look at the fundamentals, you can see that right now, about 15% of the business is advertising, and that's growing like last quarter was a particularly strong quarter. It grew at 200% year over year. But a more normalized rate I think would be kind of close to 90 to 100%. This is what they've kind of been doing for a while. But so you have this small portion of the business that's growing at, just for the sake of discussion, at triple digits. And you are, over a period of time, over a period of several quarters, people start to think, oh, actually, Fubo is a bit like Roku in a sense, because Roku had this hardware business that people didn't really like, and the margins were kind of not very profitable. But now they look, oh, actually, Roku is hardware plus advertising, and advertising has 65% gross margins, and actually Roku is a really great business, and you get that re-rating in the stock that you saw in 2020, and then you're able to, there's a new story, then the story goes forward. So I'm looking for a type of business that people's change in perception happens, and that's that's the type of investor that I am, because I'm quite selective. I work quite hard. I work all around the clock, and I follow many companies. But what I'm ultimately looking for is where people don't quite understand the company very well, and I'm looking for people to start to view the company differently over a period of a year. So I'm just looking for people. That's really what I'm looking for a change in the sentiment, okay? And that normally, if I'm honest, actually normally happens if over a period of a quarter. You'll see in a quarter. I'll give you another example, okay? So was it last week? Yeah, I think it was last week. Affirm had some really strong results, and the stock went up 30% in a day. So that moment is where I know that the stock in the previous 2 weeks had run up because there was an announcement of Affirm working together with Amazon, but there's that kind of, there was the result that came out on the earnings call, and people went through it, and there was a digestion period in the market where everyone digested the results, and it shows, okay, actually, yes, that tie-up with Amazon is real, and there's a re-rating in the stock. So that's really kind of thing that you want to be aligning yourself with. You want to be working quite hard and following as many companies as you can, but you want to see the change in the narrative, and then you kind of want to position yourself into that. And then the trick really is not to gamble. Don't go for kind of long shots that things could work out and it kind of goes up significantly. Look for things that are fairly certain to work out favorably. That's because the goal ultimately is to compound at approximately 15% or thereabouts. I know everyone wants to compound as fast as possible, but you need a method that allows you to stay in the game investing for approximately 20 years. I'm writing a book about investing. That's why I kind of always think about this 20-year horizon, because that's something that I talk about in my book. That I talked about it also in last week's podcast. I'll just briefly mention. So if you are a great investor and you compound at 16% annualized, and you put $5,000 right down today, in 20 years, you don't touch it, that's $94,000. That's great. But if you're a less good investor and you compound at 13%, you put down the same $5,000, but you're not that good as an investor, so you top it up with $500 every month. It's not a lot. On the first of the month, you get your salary, you put down $500, it's going to end up as $514K. So you're on the way to $500,000, and $500,000 is a significant amount to make in 20 years. So if for most people that's like more than you're going to make in your job. So the way to do it is really to have a process in place that allows you to stay compounding. So normally I have this rule when it comes to investing. I don't want to exit a position before a year's time. So if I'm inclined to start to build a position in something, I hold on to that stock for a year. I have this rule that I do not exit, because in that first year, a lot of the thesis that I'm working through, that I saw something, there's going to be a lot of uncertainty, and it's not necessarily that people will see things immediately the way that I see it. So I'm looking, it's going to be very volatile in that first few months. So I don't want to be kind of nervous and anxious believing that I kind of made mistakes. So I have this rule that once I take a position in a company, I don't sell for less than a year. I'm the owner of that business. So come hell or high water, I'm very much kind of the owner of the business, and I see myself as someone that wants to own onto this company. And so what I'm trying to do as much as possible is really kind of let the winner go, but be very, very brutal. And this is the secret sauce, is getting out of the losses. So if you have something that you've held for more than a year and you're down 50%, like killing those losses is really what makes a difference. There's a quote that losers average losers. And I used to be a value investor and say, oh, the stock is down and everyone misunderstands me and I'm going to average in, and I would always be selling the winners and buying more of the losers. And that sometimes works, but that's a very high risk strategy, and it's difficult to have a high success rate with that. So it's much better that you've invested in something and you can see that over a period of 12 months or something, it's blown through your expectations, it's blown through everyone else's expectations, and then you're really averaging in higher because you're kind of like, okay, the business is doing reasonably well. Now, as always, valuation is really, really important. So let's say, for example, you own a company and you can see that the company is trading at, let's say, 40 times forward sales. And you guys know that there are many of these. So I'm not going to be jumping out of my seat to pay 40 times forward sales just because, it blew through my expectations. You have to be very careful, because rule number 1 is don't lose capital. Rule number 2 is be mindful about valuation. Because I know that in the heat of the moment, like right now in 2021, you kind of look at so many of these stocks and you kind of like, everyone else is killing the market. You see, everyone is killing the market. And you saw how from February into May, the brutal sell-offs that were happening every single day. So everyone that was killing the market, you don't hear a peep from them right now. So the game is to stick with it, compound at a reasonable return that you can stick with this process for about 20 years. So a question came up about Upstart. So Upstart is So I don't know Globant. Sorry, someone asked about Globant. So Upstart is a company that I own. It's a big position for me, and it's up significantly. And there's so much noise and there's so many intelligent people saying that share price is too high, like the valuation is too expensive, and like they don't know where the business is going to be in 2 years. They have absolutely no idea. That doesn't mean like I would kind of be willing to buy more at this valuation, but I don't want to kind of deploy too much capital at a high valuation. So I would, for example, let's say in a few weeks or maybe a month or a bit longer, I would be willing to kind of build up my position slightly more, but I went quite heavy right at the start, and it worked out favorably and it's kind of up, and it's a significant portion of my portfolio right now. And I don't want to kind of go and just too aggressively leverage that position up. I'm always telling you, the most important thing in investing is the capital that you deploy, and be mindful of that. You need to protect that. That's like your lifeline. If you protect that capital, then you can live to fight another day. So, for example, so the price. It says the price target is. I don't know whose price target that is. I mean, it says price target is 234. I don't know, it's an investment that I do own, and I would be quite willing to buy more of it, but I'm very mindful not to go too heavy too quickly. So in my example of Upstart, for example, you guys might look this up on your charts. You can see Upstart has just rallied very significantly, very aggressively. What I say to everyone is buy into the stock, let's say 2% of your portfolio, and then wait a period of 30, 45 days, put another 1%, then go through the next earnings call, see that your thesis continues to develop, see that the story continues to improve, and then put a little bit more of your capital into it. Don't be too rushed when it comes to deploying capital, because in the investment market, 6 months is a very long period of time. Sometimes a month is a very long period of time. So it's when it comes to selling your position, what I prefer to do is I prefer to opt for just letting that winner go. But the most difficult thing, and it's really easy to say, but it's actually really, really difficult to do, is to sell out of something that you know is cheap to buy something that is even cheaper. That's so difficult to do. And because it's kind of, I'll give you an example that I always talk to in my family. So let's say that I kind of go and shake Irina's hand. Hey Irina, how are you doing? And I put in Irina's pocket $5. She kind of smile, think it's kind of interesting, but think nothing of it, right? So But if I did the same thing, I shook Kieran and said, hey, how are you doing? And I took $5 out of my pocket, the heart, there'll be like the cortisol, the kind of the everything, the blood, and like it's our nature. Something has been taken from her, something that belonged to her has been taken from her. So in the same with investing, so you made the investment, the stock is lower, and you believe in that company, you believe in the story, you believe that it's undervalued, and to sell out of that undervalued position to buy something that's even more undervalued is counterintuitive to our human nature. And that's really what ultimately is the most difficult thing to do, but it's really what drives, it's a secret source of investing. It's really just being able to have this detachment. So being very dispassionate about investing, because unless you're Warren Buffett, you don't really have a float. A float is basically an infusion of capital coming in all the time. Unless you're kind of someone like that, like if you're a private investor, you need to sell out of something at some point to buy something slightly better. That's just how it works. I mean, unless you have a stream of capital coming in, which I think is quite unlikely, it doesn't work in practice. So the way to do it is you have to exit something that didn't work, but don't be too quick. So that's my takeaway here is don't be too rushed when it comes to either buying into the stock or when it comes to exit the position. And just don't be too kind of worried about where the share price has gone in the last several weeks. Many people say, oh, the stock is moving down significantly. Like, do I have to do something? Do I have to exit my position? You don't have to exit a position just because the share price is going down. Share price can be going down because the competitor is losing market share. The share price can be going down because interest rates are moving. There's so many reasons why something can happen in a short period of time. You're not obliged to act just because the share price is moving. I'm kind of, does anyone want to ask any more questions? Because I see there's quite a few people on the call, and just if someone wants to kind of ask a few questions, just give it a minute. So in any case, what I think is quite important is to have that kind of balance between. So in the case of someone asked me about Upstart again. So like you don't have to do anything. I mean, you don't have to, like, if let's say for example that you've already put, let's say 3 or 5% of your portfolio into the stock, you can just sit down and you just wait to see how the earnings call comes up, and if the story solidifies, the story improves, then you can look to kind of put down another 2 or 3% of your capital. You don't have to take profits off the table, because it's quite unlikely that if you look out from the share price that is right now, if you look out over the next 2 years, that the share price will be lower. That's the time horizon that you have to think about. How is the business going to look? How is the valuation going to look over the next 2 years? Yeah, it might dip down over the next, let's say, 3 months, 4 months, anything can happen in the market. But over the next 2-3 years, how is the business? The business clearly is improving. You can see that, profit is strong, top line is growing, it's unquestionable. So it's just, there is going to be some noise, and there's going to be some periods where share price goes up or down, but really, you have to think out in the next 2-3 years. So someone asked me about HIMSS. So HIMSS is an investment that I do own. It's a telehealth company, and that's a good example. So I'm kind of looking to buy into this position right now, and right now it's going through a period where it's ex-SPAC. So many of the SPACs have unwound in 2021, and many investors are kind of just dumping all SPACs irrespective of the valuations, irrespective of their underlying businesses. But it's actually a really, really strong business where they sell at this moment only into 2 categories, which is erectile dysfunction and hair loss products. But they're going into dermatology and mental health next year in the early start of 2022. So they're going into expanding, they're innovating their portfolio of offerings. So there's still going to be that period where you need that strong quarter to come through, where there's a re-rating. So for now, you kind of build a position slowly, you don't rush, and you kind of just wait. You kind of put a few percentage in, and then you let the position start to move in the direction that you can see it's going up, and then you put down another, let's say 2% or something, and you build that slowly over time. So I don't have personally, for example, I don't advise having a lot of startup positions. I would be say very, very selective. So for example, I own 15 stocks more or less in my portfolio. I have 5 that are very, very strong, and then I have the other 10. I don't know if you class 10 as having many smaller, but the 10 that are smaller are things that I'm actually looking to build my position into. So I don't know if that's what you class as a lot, but really it's the 5, for me personally, it's the 5 core top 5 picks that I'm really looking to kind of drive my portfolio forward over the next 12 months. And I always say to everyone, don't get too caught up on an individual position. Think much more about the underlying portfolio, how the portfolio is growing is what, because that's what's really about. It's not about that one position that worked out really well and you always talk about it. Oh yeah, I had this XYZ position that did really well. Think always about the underlying portfolio. How's the portfolio performing? Okay, so I'm gonna wrap up in another minute, unless someone wants to ask me another question. So someone asked me about Teladoc. So Teladoc is a business that it made an acquisition of Livongo last year in October, and Livongo was a very strong business. I used to be a shareholder in Livongo, and Livongo was growing very, very fast rate. And Teladoc is a slightly slower business, and they had the boost from COVID period where everyone went to telehealth, and they had the boost, inorganic boost from Livongo. So as it laps and you look at Q4 of this year, the growth rate for that company is approximately 41%, but it still has 1 month of inorganic growth from Livongo. So the exit rate coming out of Q4, everyone's like, okay, how is the company going to be growing? Is the company going to be growing at 30% compounded annual growth rate, or is it going to start to mature and fall below that to approximately 25%? So that has a huge implication on the multiple that investors will be willing to pay. So in this kind of thing, I prefer not to get involved. I want to get involved in a business where I can see that the valuation is like so clear cut, so not much of a no-brainer that it's very, very cheap. I don't want to kind of go into something that is kind of attractive. It may work out. I want to be in something that is very selective, very particular, that I can say, okay, yeah, this is really, really strong. Okay, does anyone else want to ask any more questions before we wrap up here? If you do, or if you want to get in touch, reach me out on Seeking Alpha, and I'll be here also next week to talk to you guys. Yeah, okay guys, so thank you so much, and I really want to see you next week at the same time, and yeah,